joining in to talk about that. Shankar, hi. Thanks very much for joining in. We were reading your long report, so I'm just going to start by asking you about how you have thought the bidding for the coal auctions have panned out till now, and were you expecting it to be as aggressive as we've seen?
Hi there. Thanks and welcome. You're welcome to invite me. Basically, yes, we anticipated the bidding to be aggressive, especially in the first round. The broad elements being that the demand, especially for the power sector, the demand vis-a-vis the supply of coal, when you see it from a power sector perspective, there is a huge mismatch. So where there is significant high demand and the kind of supply that is going to come in from these kind of an auctions is very limited, and there is some amount of an uncertainty over the ramp up of Coal India coal and over what time period and how much quantity is likely to come up. So this is in the outer perspective where one of the fundamental reasons why it will be. The second is, if you look at within power space, there are a whole lot of other factors. Different developers are into different kind of problems. So they are already in, with a stretched balance sheet. Some of them are incurring cash losses also. So the call over there would have been, if I can secure some kind of a coal mine, what is the potential benefits that I could accrue on a relative basis? Where can I start lowering my losses, or can I start getting into profitable situation? The other angle could also be like, with some amount of PPA likely to get signed, and if I secure some kind of a coal mines, I'll be in a slightly better position to sign some of these PPAs. And given the choice that and the recent clarification that even if you can start selling on some bit on merchant, and the cost of coal for that will not be so significant, that also provides us some kind of an added impetus. But having said all of this, there are others in the fringes. There have been a couple of developments which is beyond the coal mines that have already happened, which a developer I'm surely would have been taking cognizance of it. There's something like the 525 scheme and all of that. So if you see it from a collectively perspective, different developers are in different situations, and a combination of these factors would have helped them in taking these kind of decisions.
Okay. Shankar, hi, morning. You were talking about the uncertainty of the ramp up in Coal India's production, but that was a concern that was addressed by the Coal Secretary recently, where he told us that the Coal India production would cross 500 million tons this year, and he's expecting it to cross 1 billion tons over the next 5 years. How confident would you be of Coal India meeting this production target?
Okay, what I actually meant is, because most of the power plants, if you notice, they are already up and running. So it is actually on their ground, and they are either not working optimally, and resultant there could be some kind of a less than optimal return. So whether it is losses or lower returns. The ramp up of Coal India is, yes, it could happen, but like you rightly said, it is over a period of 5 years. So like over the next 2 years, the cash losses, if somebody would have to underwrite, that could have been a significant amount. It obviously varies from developer to developer. So that is something which, if you're already with a stretched balance sheet, I doubt how many people or how many developers would be in a position to look into something of that sort. So that is what I was trying to address it. So securing something in the short to medium term, maybe the net present value could have been slightly better in terms of your relative position.
Okay. Shankar, how would you explain, the financial viability of, say, a CESC going forward, considering that their bid for the Sarastoli block, and I hope I pronounce it correctly, was assumed to be extremely aggressive?
Okay, once again, in the CESC case, you should look at the relative perspective that if they did not get this kind of a coal or retain this coal, the alternative would have been to source imported coal. And you are aware, even after these suppressed prices, the delivered cost of imported coal to any of the power plants are close to as good as double the current levels. So they were working around the objective of either you do not run that plant or use it imported coal, and the tariff goes significantly higher, where you might be out of the merit order dispatch, and it will still become a difficult situation for the regulator to pass through. So that, having said that, they also have this option, like I said, about the merchant. And so if they try and can mitigate some of the losses by quoting this kind of a bid. Then lastly, because there is a fungibility agreement also. So if you have another power plant where you can use this coal mine, they have a Dariwal power project, so they might be trying to look at that project as well. So all in all, they have taken a kind of a calculated stance of trying to mitigate the risk and they offset the loss that they could have potentially got after putting this kind of a bid.
Okay. The most surprising aspect from yesterday was what happened with JSPL, Shankar. I mean, while most players were bidding up the price, the competitive intensity was really low when it came to JSPL's mines. How did you read into that, and what do you think the way forward could be for the company now?
Now, as far as this block is concerned, in this confined to especially the power, I would once again try to first from a JSPL perspective and then from the competition perspective. I would like to believe JSPL had put in 3 bids quoting 3 different power plants for the same coal mine. Now the cost for probably the captive, the 1000 megawatt merchant plant, which is already operational for the past 5 odd years, that would have been already low, and but for the 1200 megawatts out of the 2400 megawatts, I don't think so they might be having a assured fuel linkage. So they might be taking using this coal mine to largely to secure fuel for that, and which enhances their chances of entering into kind of a PPA because they would have sourced a cheaper fuel. That I perceive that could be one of the stance. The second stance would be the rail connectivity or the transportation connectivity is slightly limited or constrained with respect to this coal mine, with the nearest rail, if I'm not mistaken, something like 50-60 kilometers away, and the road connectivity is also not so good. This could have been one of the deterrent for the competition to be it.
Okay. Shankar, last question then. How do you expect the future bids to be? Which are the blocks that you would be watching out for most closely? Which one do you think will see the most aggressive bidding? And your sense in whether it will be as aggressive as what we've already seen?
Slightly difficult to spell out on mine-wise thing, but what I would like to believe is, now considering that there is roughly 20 gigawatts of capacity which do not have a PPA. Now, and you can do the math, for every 1000 megawatts you require a 5 million ton per annum. So, and whatever is the coal mines which are going to come up in the next level, this dynamics will continue to have a play. So the more open capacity that you have, or the more unviable current operations you're there. So like I said earlier, but by getting a coal mine, if you're able to secure, or you're in a better off situation going forward. So to that extent, I continue to believe the bids will be aggressive on the power side.
Okay. If I have time for just one last question, Shankar, because you're giving us a lot of details. My colleague Pragya had a query where she said that you have indicated in your report that the coal cost will now be only about 400 to 500 rupees per ton, as against the earlier assumed close to 3,000 rupees per ton. Can you just elaborate on this point of the potential merchant sales minimizing losses, because this figure is something that not too many people have spoken about?
Okay, so what was given to understand, or at least our interpretation was there earlier, if you get a coal mine through an auction, so whatever is your bid price will be used as the reference price for the fuel charge in your PPA bids. But if you were to use the same coal to sell merchant, the reference price will be almost equivalent to what the non-power segment is bidding for. So in this case, whatever is the reference price, if you are looking at for the non-power, is we are getting 2,800, 3,000, those are the kind of levels. So that is what I meant. But subsequently, there seems to be some clarification that even for merchant, the reference price will be around between 400 and to 500 rupees, while it will change on mine to mine, but this is what it will be. So that suddenly makes it reasonably kind of an attractive for somebody to do kind of a merchant, because your fuel cost will be reasonably lower and not as high as if you consider 2,800.
Okay. All right, fair enough, Shankar. We leave it on that note. Thank you very much for joining in and giving us this comprehensive analysis of the coal block auctions.